Welcome back to the deep dive. If you spend any time watching financial markets, you've undoubtedly seen something peculiar. Certain price levels act like absolute magnets.
Oh, yeah. Just pinning the market down.
Exactly, resisting momentum, while other times the asset price just explodes into these massive, kind of unpredictable moves. It really feels like there's a hidden force driving the market something, far beyond simple supply and demand on a basic chart.
Definitely.
So our mission today is to give you, well, sort of X-ray vision into that dynamic. We've synthesized your sources on advanced options trading concepts, and we are going deep on the most powerful and often most misunderstood of the Greeks, gamma.
Good topic.
This deep dive will decode how gamma drives major market dynamics and, maybe most importantly, how understanding it reveals the strategic intent of the professional institutional players.
Exactly. And options are more than just like speculative tools, aren't they? They are really the bedrock of sophisticated risk management and profit generation. For the buyer, they offer the right, but crucially not the obligation, to engage with an underlying asset. Now, while lots of traders focus on candlesticks and, basic indicators.
The usual stuff.
Yeah, the usual stuff. The invisible hand pushing and pulling prices is really found within the derivatives market. And that hand is driven by the dynamic interaction of option risk parameters, collectively known as the Greeks.
Okay, let's unpack this hidden force then. Starting with those building blocks that the sources really emphasize are essential. Before we even tackle gamma itself, we probably have to establish the context of delta because they seem fundamentally linked.
Yeah, that's a necessary step. Delta is basically the sensitivity of the option price to a $1 change in the underlying asset's price.
Okay.
It tells you how much the option price is expected to move. It's your immediate risk exposure, sort of the speed of the option price change.
Got it.
But the real driver of market structure, the thing that causes those pins and explosions, is gamma. Your sources define gamma as the rate of change of delta. It measures how much an option's delta will change for every 1 unit move in the underlying asset's price. So think of delta as speed. Gamma is acceleration.
Ah, okay. So delta tells us where the market is reacting now, but gamma tells us how that reaction changes if momentum builds. It's about the future sensitivity.
Precisely. And this brings us to how we quantify that mechanism through gamma exposure, or GEX.
GEX, right. I saw that mentioned a lot.
Yeah, GEX is the aggregate measure, the total gamma risk across all options positions in the marketplace for a given underlying. When GEX is high at a certain price level, you are looking at massive institutional positioning that really dictates market behavior.
Okay, so GEX is the total exposure. How does that create the pin?
Right, so here's where the mechanism of the pin comes in, which is really the key insight we need to convey from the sources.
Yeah.
When professionals, specifically the option writers who are often short gamma, have large GEX positions, they are forced to dynamically hedge their delta risk.
Dynamically hedge,
Yeah.
meaning?
Meaning, if the stock price drops, their delta changes in a way that increases their directional risk. So to get back to neutral, they must buy the underlying stock.
Ah, buying into weakness.
Exactly. And if the stock rises, their delta changes the other way, and they must sell the underlying spread to re-hedge.
Selling into strength.
Right. This constant mechanical hedging action, buying dips, selling rips, is what acts as the brake, or that magnet effect, keeping prices pinned in a sometimes surprisingly tight range around those high GEX concentration levels.
Wow, okay. That dynamic hedging totally explains the market resistance we often see. It's not just random buyers and sellers, it's the structural force.
It is.
And the X-ray vision, the source's promise then, comes from understanding gamma density. How's that different from GEX?
Good question. So GEX is the total risk, like the overall tide level. Gamma density tells you where the biggest waves are concentrated. It's the concentration of GEX at specific strike prices. So if GEX is the total risk profile of the ocean, gamma density gives you the exact latitude and longitude of the largest, most powerful currents. It lets you see through the surface noise, the day-to-day chop, and locate those magnetic zones that the professionals are actively defending through that hedging.
That's a powerful visual. Seeing the currents, not just the surface. The power of gamma is clear, but, all this sophistication seems pointless if you don't manage the inherent risk of volatility, right? Especially with options.
Absolutely. Risk management truly is the backbone of successful trading, particularly when dealing with nonlinear instruments like derivatives, where volatility itself is a huge factor.
So how do the big players use these Greeks to defend their positions? The sources mentioned hedging strategies.
They did. The primary hedging strategies outlined in the material suggest professionals lean heavily on two main methods, delta neutral and its sort of more powerful relative, gamma neutral.
Okay, delta neutral first. What's the goal there?
Delta neutral is really the foundational strategy. The goal is simple. Set up a position, maybe a combination of options and stock, that has zero net delta exposure.
Zero delta, so it doesn't move with the stock price.
Well, not for small, immediate movements in the underlying asset. The position is momentarily immune to those tiny price changes. It neutralizes that instant directional risk.
Okay, that sounds defensively focused. But, if the market moves more than just a tiny bit, doesn't gamma kick in and mess up that neutrality? Does the market ever punish traders who only rely on delta neutral hedging?
It absolutely can. Yeah, that's the big drawback. Delta neutral positions are, by definition, highly sensitive to gamma.
Because gamma changes delta.
Exactly. So the underlying asset moves far or fast, the trader's delta shifts significantly, and they have to rehedge constantly to get back to zero delta. That means racking up transaction costs, slippage.
It can be inefficient.
Okay, so it works, but it requires constant adjustment.
Right. And that dynamic inefficiency leads sophisticated traders to the next level, gamma neutral. Gamma neutral. Sounds more advanced.
It generally is. Gamma neutral is designed to maintain zero net gamma exposure across the portfolio. The sources note this is often seen as a more advanced strategy because it manages the acceleration of risk, the change in delta, not just the initial speed or delta itself.
So you're hedging the change in risk.
Precisely. By achieving gamma neutrality, professional traders drastically reduce the necessity for frequent rehedging. It stabilizes their positions and lets them navigate periods of unexpected volatility much more efficiently, much more smoothly than their purely delta-neutral peers.
Okay, that makes sense. This shift from delta neutral to gamma neutral sort of reveals a hierarchy of sophistication in risk management.
It really does.
Now, here's where it gets, I think, genuinely strategic. The sources suggest gamma is like the market's polygraph test. How can we use the split between long versus short gamma positions to decode the market's current intent and maybe see the conviction levels of the big players?
Yeah, that's a great way to put it, the polygraph test. We basically decode market intent by analyzing whether the overall positioning, often inferred from GEX levels and OI changes, is predominantly long gamma or short gamma.
Okay, let's start with long gamma. What does that tell us?
So, take the long gamma position first. This positioning benefits, often dramatically, from increased volatility.
Benefits from chaos.
In a way, yeah. These traders are typically net buyers of options. And critically, by being long gamma, they are signaling that they expect volatility and directional moves to happen. They profit from rapid acceleration, rapid price changes in either direction.
So they want the market to move and move fast.
Exactly. They aren't betting on slow, grinding moves. They're often targeting structural inefficiencies, volatility gaps, maybe around major events like earnings, Fed meetings, things like that. They need that acceleration.
Okay, clear. And then there's the other side, the position that seems to underpin that pinning phenomenon we discussed earlier, short gamma.
Right. And this is often where the market makers and institutional sellers live. Short gamma positions suffer from increased volatility. They get hurt by big, fast moves.
So they want stability.
Precisely. Traders in this position, typically the option writers or sellers, are essentially expecting range-bound or consolidating markets. Their profit often comes from time decay, theta, just collecting premium while the market stays calm. They're selling optionality, selling the right for others to bet on big moves, and their entire risk profile is built around the assumption of stability, or at least predictable, manageable moves.
So when we see those massive GEX concentrations we talked about, that usually implies heavy short gamma positioning by market makers and institutions. And that tells us the market is likely to exhibit that mean reversion behavior, that pinning, until that short gamma wall is somehow broken.
Exactly right. That's the key dynamic. When the market stays within the expected range defined by those high GEX zones, the short gamma players just keep hedging, buying low, selling high, reinforcing the range.
But what happens when it breaks?
That's when things get exciting. When the market penetrates a high GEX zone, especially on high volume, the short gamma players are forced to switch their hedging posture dramatically. If the price moves high enough, fast enough, to force a massive, rapid re-hedging scramble.
They have to chase the move.
Yes. They suddenly have to start buying aggressively into the rising market to cover their escalating short delta exposure or selling aggressively into a falling market. This phenomenon is sometimes called the gamma flip. that pinning action completely collapses.
And the price accelerates.
Violently accelerates, often, because the very players who are suppressing volatility are now forced to contribute to it. They're buying into the existing momentum instead of fighting it. Identifying this transition point, this potential gamma flip zone, is absolutely key to anticipating major breakouts or breakdowns.
Wow. This connection really shows us the market is absolutely not random, is it? It's about control, concentration, and these invisible forces that pin prices exactly where the big players want them until they don't.
Precisely. And this brings us neatly to the role of the option writers themselves. The sources call them the silent crowd.
The silent crowd, I like that.
Yeah. These aren't the, emotional retail speculators reacting to every headline. They are the institutions, the market makers, the professionals who are actively shaping the range, the implied volatility, and the short-term direction by their willingness to hold or adjust these critical short gamma positions.
So we need ways to see what they're doing or intending to do.
Exactly. We need analysis tools like the spectrum chart mentioned in one of the sources that are specifically designed to track the intentions of these writers, not just the resultant price action or volume after the fact.
So we are tracking intent. That feels like a massive conceptual leap beyond just looking at a price bar or a moving average.
It is.
The sources really emphasize that to truly trade with intent, you need to see the market in layers. Structure, flows, footprints, positioning. Relying solely on candlesticks, they argue, only gives you the shadow of the true market activity, not the substance driving it.
Yes, absolutely. The most superior insights, the sources suggest, come from integrating gamma analysis with other established market tools. We don't throw away the old tools, we enhance them.
Like what specifically?
Well, things like market profile, which shows where value is perceived over time. Order flow analysis, tracking aggressive buying and selling in real time. And, of course, open interest analytics, seeing where positions are clustered.
So you combine these?
Yes. This integration allows you to cross-reference the areas of high gamma density with areas of known trading activity, like high-volume nodes or value areas from market profile.
So when you combine these elements, when you see that high gamma density strike price sitting right on top of a major distribution point from a market profile chart, for example,
Right.
the sources suggest this provides a kind of playbook that repeats every series and every settlement cycle. It moves traders past just reacting to price charts into a realm of anticipating, or at least understanding, predictable institutional behavior.
That's the goal. Practically speaking, this combination helps you analyze max open interest, for context, sure, but also brings in things like VWAP, the volume-weighted average price, which is a key institutional benchmark,
Okay.
and the POC, or point of control for market profile, which is the most heavily traded price level within a given period. Overlaying gamma data with VWAP and POC really informs smart strike selection. It helps you identify if the dominant market activity near a key gamma level is institutional writing activity aimed at pinning the price, or aggressive buying activity aimed at forcing that gamma flip we discussed.
Seeing the nature of the activity at the critical level.
Exactly.
Yeah.
Writing versus buying, pinning versus flipping.
This has been a tremendously insightful deep dive. I feel like we've really unpacked a lot. The fundamental takeaway for you, the listener, isn't that gamma is simply, another technical indicator to slap on a chart.
No, definitely not.
It's the engine, isn't it? It's what reveals why price often fails to move or why it suddenly explodes with such force. We're effectively tracking the intent of the market's silent crowd, understanding the mechanical forces they employ, willingly or unwillingly.
And what's truly fascinating here is realizing how that sophisticated control exerted by those large option positions fundamentally changes the trading environment itself. We see that the short gamma crowd acts as this powerful stabilizing force, keeping things in check.
Until it doesn't.
Until it doesn't. And when that force breaks, the market accelerates exponentially, often catching purely price-based traders completely off guard.
Right.
So this raises, I think, an important question for your own trading philosophy for you to think about. If the future is, as the sources compellingly claim, at least partially written in gamma, revealing the specific price targets and control mechanisms of the big players, what foundational assumption about market randomness do you perhaps need to discard to truly trade with intent?
That's a powerful thought to mull over, challenging that idea of pure randomness. Thank you for sharing your source material with us for this deep dive into the hidden force of gamma. It's been illuminating.
My pleasure.
We look forward to seeing what you send us next time.